Welcome to Power Charting. I am your host, Bruce Fraser. Will the bear rage in the new quarter? A compelling stock market analog and a stock market update. The new quarter has just begun, and we have talked about how the quarter end has been very important in the financial markets here in the recent past and really through history. So let's continue on with that discussion now that we are in the middle of July, and let's get started. But first, sadly, we as a family here in Power Charting must say farewell to our dear friend, Andrew Cardwell, Dr. RSI. He was a brilliant technician, brilliant strategist, dear friend to us all, could not do enough to support and help those that were interested in his RSI method. He had followers the world over and made fans of us all right here on Power Charting. And sadly, we lost him in June. And we say farewell, Andrew. We will miss you dearly. And we will go back and we will review those great episodes that you did with us and also those Your Daily Fives. So you live on in that wonderful work. So, so long, Andrew. Let's talk about the Wyckoff price cycle for a minute. This is a classic cycle, very simplified, of a bull market, distribution area, markdown, and then accumulation, and this happens over and over and over, cycle after cycle throughout all of stock market history. And the thing that is, I think, useful to think about and consider is, and we're going to talk specifically here about distribution, is what's the sequence of events in the major asset classes. And so we can see here that typically bonds will top out and go into their bear market before the final distribution area forms for stocks, because this is the stock market cycle. And so somewhere over here during the bull market, interest rates will start to go up with a really fast moving burgeoning economy. Secondly, the stock market will top out with the distribution area by definition. And so you can see that stocks will follow bonds into their primary bear market. Finally, the third thing, and this is important to consider, is inflation beneficiaries, commodities, inflation stocks, and so on, will tend to have a lagging bull market, one that goes past the top in bonds, past the top in most stocks, and into the slowdown in the economy. And in fact, we can see that that's exactly what has happened here recently, is that you've had this big run up in commodities, you've had a run up in oil prices and gasoline, which we have documented here in recent episodes. And I want you just to keep this in mind as we move forward and consider the sequence of events in a primary distributional top and bear market. Here, just for your review, is the stock market life cycle model, which was really put together by Dr. Pruden and Richard D. Wyckoff. And this beautiful representation done by Roman Bogomazov is to put the accumulation, schematics, the markup, and distribution all on this chart. And I want you just to take the time to study this, and we'll go through, put these animations in, study this, think about it, put it on your wall. Then, because we're in a bear market, I think it's really good for us to focus on our skill sets. So go back, look at these blogs and other blogs that I've written on Wyckoff Power Charting, where I talk about accumulation. I talk about these two schematics. And also there are others. Let's talk about distribution. Here is the distribution blog. that you can go look at, and there are others, and there are many case study examples throughout a number of blogs through the collection. And so study these distribution schematics. I used to print them, put them on the wall in my office so I could refer to them often. And then finally, something I consider to be very important is the concept of reaccumulation. And so here is a blog to read. So keep sharpening up, study, and make sure that you have really done a lot of personal case studies, etc. Now, here is the CPI. We know that the June number, which came out yesterday, Wednesday, this is recorded on Thursday, is 9.10. Our study here of the horizontal point and figure analysis going back to 2000, this yellow area gives us a count that ranges from 8.25 up to 11.88. And so you can see here that we're kind of right in the middle of that range right there. And the question that we want to ask is, can CPI, can inflation start to taper off from this level? And we're going to give you a case for why that could be possible, but also that CPI tends to react slowly to the changes in commodity prices, etc. Here is a chart of the relative strength of the Nasdaq 100 to the CRB Commodity Research Bureau Index. You can see this incredible uptrend of the Nasdaq stocks relative to the CRB from 2011 on to 2020, 2021. Well, this made commodities very inexpensive to very expensive and overpriced Nasdaq 100 growth stocks, the mega cap names. Then magically, I say that tongue in cheek, in 2020 to 22, you can see distribution forming between the NASDAQ stocks and the CRB. The CRB is getting ready to go into a primary uptrend, and NASDAQ stocks, growth stocks, are getting ready to go into a primary downtrend. Well, at the point at which this trend channel was broken, the CRB started to really outperform dramatically. Now, keep in mind our price cycle chart from the beginning, where we talked about how inflation tends to lag. We would look at CRB as a measure of this lagging inflation characteristic, because notice how inflation beneficiaries are outperforming now the growth stock names in this index. And also you could put this chart up against the Dow Jones or the S&P, and it would have a similar look to it. So this is an example of what we talked about in the classic business cycle relationship, lead lag relationship of bond stocks and inflation. So we will continue on with that. I want to show you an old legacy chart here, which is really a unique characterization or construction of point figure using percent scaling instead of using regular scaling. So this effectively makes this a logarithmic scale. And so 3 box, each one of these grids is 3%. And I said 3 boxes, 1 box method, 3% scaling. And look at these beautiful reaccumulations throughout that gave wonderful counts from 2011 on in the ongoing bull market. Well, finally, we had, after the COVID decline, a rather large accumulation. This accumulation resulted in a count that took us up into the area of 4583 on the S&P. Now, let's bring that up to date. You can see that count worked out beautifully. We originally showed you this count in 2021 August, which was right at the point of the peak, because that's when our point and figure count was fulfilled. And so we showed it to you at that time. And then a distribution forms, you can see here on a percent scaling. So we extend our trend channel. And now let's bring this more up to date so that you can see what has happened since. The distribution now looks complete across this area. So let's take a count. This point figure count again is 3% scaling. and it takes us down to a count of 3618 on the S&P. Well, we got within one box, 3% of that objective. Actually, we got closer, and I will show you, because we got to a low, it appears, of 36, I believe it is. And yeah, right here. And so you can see that. And so here is a traditional point and figure chart with two smaller distributions, a small distribution here, redistribution across this area that in April turned into a new downtrend, and we fulfilled this count at 3,800. And so here you can see we actually threw under that and went to 3636. I'll go back and show you again 3618. We only missed this lower count by 18 points. And so I would say that's pretty close to a good hit. So is it possible that we may have an attempt to either build a new distribution, build an accumulation, or just keep going? Well, I think that this is going to be interesting for us to consider. And so here you can see that this area, and this is into June, so this is through June 13th, gives us a count down to this 3,800 where we went to the 3636, and could continue to build a cause in here for, and we won't know till the cause is complete, but we've certainly exhausted this area right here, just as this area was exhausted right here. Okay, bigger count though across this entire structure is looming. And so let's talk about where that could go, just because we do not want to lose track of the fact that there are lower counts in the structure of this distribution. More on that in a minute. Takes us down 2950 to 3250. It doesn't have to be a straight line, doesn't even have to get to this number. There may be a attempt to rally, there may be a sideways consolidation, and then a new decline, and we will be able to assess that only after we get some kind of a completed distribution or accumulation, which is what we had here and here. Okay, so let's keep that all in mind and move on. Let's look at our historical analog. This is so fascinating to me, and I want to share it with you and have you thinking about it also. And that is the analog of 1970 to 1975. We actually did a anatomy of a bear market on this bear market, which was a terrible bear market back in the mid 70s. Well, there are other reasons why this analog plays potentially to the current environment and may tell us more about what could happen here. So looking at this, one of the big events that happened, well, let me just take you through a walk of this chart so you can see the overview. In 1971, we had what appears to be a buying climax right here. And this buying climax was followed by an automatic reaction and then a rally up into an upthrusting action, a failed last point of supply rally here in 73, and then a sideways redistribution, and then failure down into a markdown phase. This whole structure goes from 1971 to 1974, substantially large in time. This is 1, 2, 3 years in duration, building a distribution, which resulted in a substantial decline. So this is really impressively large. And you can see that here we have the elements of ice. Look at the inability of this market to be able to get ahead of steam and have a good rally. It just sort of goes sideways, but it does it for more than 2 quarters. So this is a really long period of time through here. Well, now let's look at interest rates. Now, keep in mind, as we just talked about the growth stock era in the Nasdaq 100, that was kind of a Nifty 50 era, and I would encourage you to go read about the Nifty 50 and do some research on it. This was around the end of the Nifty 50 era. These were 50 stocks that you had to own no matter what. and you own these stocks, never sell them. They're one decision stocks, they called them. Sound familiar? Sounds a little like the growth stocks, the mega caps of today. So here we can see that there are similarities between the bull of the 60s, and I encourage you to go look at the 60s, but into this big distribution. Now, down here at the bottom, this is the Fed rate at the bottom. And something very interesting is at work here. So let me clean this chart up a little bit. So the low interest rate in the first quarter of 72 is 3.29%. And then over here in 74, 2 short years later, the rate on the Fed rate goes to 12.92%. And so a substantial increase in interest rates in 72, 73 into 74. Well, these interest rates are rising. Well, as this distribution is just getting started over here at the beginning of 72, because we can see the buying climax actually clocked in 71. Something really important happened in 1971, and that was that President Nixon closed the gold window. Now, what that meant is that central banks around the world could trade their dollars to the US and get gold from the US in exchange for those dollars at a rate. And Nixon closed the gold window, which effectively took the dollar off the gold standard. And that is considered to be an sort of the backdrop or the foundation for unrestrained money printing. And so whether or not that happened at a high rate, well, you be the judge. We'll look at this. Interesting anecdote of that era was that very day, August 16th of 71, when Nixon closed the gold window, I was on a jet, 747, flying over the Atlantic with my buddy. We were going to Germany and Austria to go see friends and family over there. And we were in the air when Nixon announced the closing of the gold window. In JFK, before we took off, the world was a normal place. When I landed in Germany, in Frankfurt, at the other end, the world was literally in chaos. And it was because the dollar had become trash. Nobody wanted to own it. Everybody understood the implications of the dollar coming off the gold standard. It was chaotic. So that was my first lesson into market volatility and unexpected market events, and also the effects of currencies one to another between countries. So that was really an amazing time for me as a young man. Anyway, so let's continue on. I'm going to run out of time, but I want to look now at the CPI throughout this period to see what the CPI did. And let's start with the end of 1971. The CPI was a somewhat modest 3.3%. We have been running under 2% here for quite a while in recent years. So the CPI was very low and manageable at in the aftermath of Nixon closing the gold window. Then and he closed the gold window because there was a run on the dollar, by the way, and that was because there was inflation pressures that were building. And so you can see at the end of 72, the CPI had only gone from 3.3 to 3.4%. And so very modest increase, but look at the Fed rate. The Fed rate here goes it just continues to march higher all the way through the year. So the interest rates were climbing 3.29 at the point that we exited the year. Interest rates were at 6%. So a substantial increase percentage-wise, beginning of the year to the end of the year. What happened at the end of 73? CPI went to 8.7%. Very similar to the rate that we're at now at 9.1%. So when inflation began to really take off, it took off quickly. And you can see here that the bear market was already underway. Distribution was largely complete. You had a substantial decline here and a very poor ability to rally in the area of key support. So then what happened at the end of 1974? Because notice the incredible markdown that we had with a 47%, 46.6% decline, high to low, which does not reflect the lost purchasing power of the high inflation period. This decline, inflation adjusted, was the worst stock market decline since the 29 to 1933 Great Depression. So note that at the point at which this breakdown occurs right here, sorry, the interest rate policy is starting to become accommodative. So you can see here an important break in interest rates as the last leg down. And this last leg down could not be stopped by accommodative interest rate policy. And so it just really just kept falling and falling, even though interest rates were a substantial easing mode throughout that whole period. So here we can see at the end of 74 that inflation had reached 12.3%. So a continuation, even though interest rates were falling, and interest rate policy was becoming accommodative, inflation had continued to rise right through the end of the year. Very interesting. Could this be a clue about how things are going to go here in our future? Well, let's take a look at the current market and clean this up. And here we see that the distributional top in the S&P is much smaller in size. This is August of 2021, and this is March of 2022. And this, calling this the distributional top, is significantly shorter in duration than what we have up here in 1971, 2, 3. Now, note the interest rates. This is the Fed rate. It's only through the beginning of June, but interest rates have been basically at a zero bound all the way into 2022. And as we all know, they're starting to go up in earnest. So we'll look at that here in a minute and look at the yield curve, and we'll have to finish there. But you can see that there is a commonality in the way that these markets relate to each other. The duration and the size of this current distribution, much smaller. Does that mean that the Fed is going to be more accommodative, that they're going to be more reluctant to raise rates in the first place, where in 73 to 74, they were, interest rates were going up substantially, going from 3% up to, let's see, 3% up to, in this case, touching 13%, 12.92, substantially higher. We're nowhere near those levels. It's hard to imagine interest rates getting to those levels in this cycle, but they could, who knows? But this very sort of benign Fed policy that we have now, even if they raise a full 100 basis points at the next meeting, I'm not predicting that, but people are talking about it. It could very well be that we have these interest rates are very close to their peak for the time being. Okay, so let's take a look at, with the time that we have, let's look at the yield curve. So this is pretty important, and I'm going to go very fast. You've seen this chart before. Rates are rising both on the 10-year and on the 2-year at a pretty fast clip. The 2-year is rising faster. 10-year is kind of attempting to stall out. What's really important here is note that the yield curve, which flirted with zero for a long time, is now distinctly negative. This is a tight money environment now. So let's look at the history of the yield curve. So you've seen this chart before. These are green arrows or flirtations with a negative yield curve. And we call this area down here flat yield curve tight money. Easy money is up here with a steep yield curve, which shows accommodation and is generally very good for the stock market. And you can go look at how the stock market does with a steep yield curve environment. But here, note that we now have a negative yield curve. It's pretty substantially, and we could spend quite a bit of time in negative territory. And I put a yellow box up here at the area where we had long-term negative interest rates or negative yield curve up here. And you can see that both prior distributional and bear markets both were preceded by pretty negative yield curve. And with that, I will say so long and thank you for being here, and we'll do it again next week. Take care, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.